Moving from the economic data to the stock markets, I want to talk about the investment returns for the quarter because it really was a bloodbath across all asset classes. The Dow Jones was down 11.25% on the quarter. The S&P 500 down 16.5%. The Russell 2000 down 17.5%. And the NASDAQ composite down 20%. And of course, a lot of the big tech stocks in the NASDAQ composite were down a lot more than 20%. The ARK Innovation ETF, I always like to talk about that one. This is the most speculative part of the spectrum. These profitless or money-losing innovation companies, as Cathie Wood likes to describe them. Yeah, they're innovating in new ways to lose money. But the ARK Innovation ETF was down 40% on the quarter. Now, it was outdone by the Grayscale Bitcoin Trust. I always like to talk about these two together. That was down 60% on the quarter, which slightly outdid the losses in Bitcoin. Just kind of looking at the chart and guesstimating, I think Bitcoin was down about 58% on the quarter. Now, to compare fool's gold to actual gold, gold was down on the quarter, but not nearly as much as Bitcoin. Gold was down 6.7%. Gold was down less than the best performing stock market index, the Dow Jones. So even though it went down a lot less. And so somebody who was holding on to gold, if they wanted to convert that gold into stocks, they have a lot more stocks than people that held stocks the whole way down. Now, of course, a better safe haven with the benefit of hindsight was the US dollar. People have more purchasing power if they were in the US dollar than in gold. That may not be the case in other currencies like the Japanese yen, but the US dollar index ended the last quarter at 98.3 and it finished the second quarter at 104.685. So a big gain for the US dollar. There was also no safe haven in bonds, even though we did have a bit of a rally towards the end of the quarter. If you look at the yield on the 10-year at the end of the first quarter, it was 2.327, and it ended the second quarter at 2.972. So whether you were in stocks or bonds, you still lost a lot of money on the quarter. But some of the biggest losses on the quarter, other than in cryptocurrencies, were racked up in the gold stocks. The GDX index of senior gold stocks lost 28% on the quarter, and the GDXJ, the junior gold stocks, they lost 32% on the quarter. So those stock indexes were down more than the NASDAQ. Now, that's certainly very disappointing to a lot of people who have been following my advice or clients of ours, because while I was right to tell people to get out of the NASDAQ, as I thought rising interest rates and recession were going to be bad for the NASDAQ, I thought they would be good for gold stocks. And I was completely wrong. Gold stocks went down even more than the NASDAQ. So why was I wrong? What did I miss? And does that mean that I should change my strategy now because the markets have proven me wrong, at least for the last quarter? Well, go back and think about my thesis. What was I saying? I was saying that I thought the economy was going to be a lot weaker than everybody thought. And therefore, I thought the Fed was ultimately not going to be able to raise interest rates as much as people think. Because remember, the premise of fighting inflation and raising rates was always based on the belief that the US economy was strong enough to withstand higher interest rates. And it was my view that as more and more economic data came out to confirm that the Fed was wrong, that Yellen and Biden were wrong, that I was correct, that the Fed was overestimating the strength of the economy. Just like it underestimated the strength of inflation, I thought the markets would be smart enough to see beyond the rate hikes to the rate cuts. And in fact, the markets have already started to price out some of the rate hikes they priced in, and the markets are now anticipating that the rate cuts are going to start in early 2023. So everything that I thought was going to happen with respect to the economic data and the market's opinion on rates, all that has come true. And in fact, that's the second prediction I got right, because not only did I say that the economy was weaker than the Fed was claiming, I said that inflation was stronger. When the Fed was still on the transitory bandwagon, I said inflation is not transitory, it's permanent, it's not going to go back down, it's going to get worse, and I was right on that forecast. And that forecast also led me to recommend gold stocks, because I thought gold stocks didn't accurately reflect how much inflation we were actually going to have, because the markets expected transitory inflation and I knew it was permanent. So I thought the gold stocks would go up once investors found out that they had underestimated inflation. But then they started to worry about the inflation fight rather than the inflation that they didn't expect. And so they started to sell gold stocks. But I remained convinced that once they found out that the economy wasn't as strong as they thought, and that the Fed wasn't going to be able to fight as hard as they thought, and that we weren't going to get all these rate hikes and this tight money policy, that then they would move back into gold stocks when they discovered they were wrong about the economy, just like they were wrong about inflation. But again, they dumped gold stocks even after they found out that the economy was in recession, and began backing out some of the rate hikes that had already been priced in. So it is very frustrating to have gotten both inflation and the recession right, when those were not mainstream calls. I was an outlier. Everybody was looking for the opposite. The consensus was transitory inflation, super strong economy. So I got both of my forecasts right, but I didn't get paid, at least in the gold stocks. Now, the non-gold stocks that I owned did a lot better than the NASDAQ and even the Dow Jones, despite a strong dollar in the second quarter. But the gold stocks, where I expected to actually make the most money, is where I lost the most money. Now, the question is that going to turn around? And I am 100% confident that it will, because the markets still don't get it. Because the people who thought inflation was transitory when it wasn't, the people who thought we had a strong economy when we didn't, still don't understand where this is headed. Because right now, they're thinking that somehow recession is bad for gold. Even though gold has not gone down that much, they think, oh, less demand, it's a recession, that's going to be bad for gold, that's going to be bad for gold stocks. But they still think the Fed is going to have higher interest rates, we still have a strong dollar. So even though the investors don't think the Fed is going to be as aggressive as they thought before, they haven't backed out any of their negative sentiment in the gold market. They still expect whatever rate hikes are coming to be bearish for gold. And I still don't think they've factored in a return to quantitative easing. Maybe they're just thinking about the Fed is going to back off on rate hikes, but they're still going to go forward with quantitative tightening. I don't think there's any way that that is possible. I think when the markets actually understand what's coming, you're going to see a huge rally in gold and an even bigger rally in gold and silver stocks. It's just going to happen later than I thought. And when it starts, I think it's going to be vicious. Investors are finally going to be able to put two and two together and figure this out, because the political pressure on the Fed is going to be immense once it can no longer hide behind the false narrative of a booming economy. Once it's proven that the economy is in a bust, then the Fed's mission is clear, because the Fed's been able to say, we're focusing solely on inflation because they claim we have this great economy. If they have a dual mandate, employment and the economy versus inflation, yes, they can focus on the inflation mandate when they think they're okay on the other one. We got this super hot labor market, nothing to worry about, so we can focus on inflation. But once that super hot economy is ice cold, they were predicting a soft landing. Well, we've already crashed. Now it's a totally different scenario. Now they can't claim that they're going to focus on inflation, because they can't also claim that the economy is in great shape and we have low unemployment when unemployment is going up, and when everybody knows if the Fed continues to raise rates, that's going to put even more downward pressure on the economy, more upward pressure on unemployment. In fact, if the Fed just stops raising rates, if they leave rates where they are, they're still too high. Mortgage rates are still too high right here. We're going to have a collapse in the housing market. The cost of government to servicing its debt has already gone up dramatically. So it's not enough for the Federal Reserve to pause in the hikes. If they want to do something about this growing recession that's going to turn into a financial crisis, depression, they're going to have to slash interest rates all the way back down to zero. They're going to have to launch a QE program even bigger than the one that just ended.